On today's drill down, we are going to look at the Metaco website because I think that the information and the news lately with Ripple is interesting. There's a new board member, there's information about the lawsuit and the Hinman emails. There's things like that coming out, but there wasn't really anything interesting for me to cover about that. So I'm taking a little bit of a different tact, and we are looking at something that Metaco, their new acquisition, has said, because I found some facts in here that really got my attention. And when we get there, I'll let you know. So let's cover this article. It says, learnings from Metaco talks in 2022. Digital assets continue to gather momentum despite one-off challenges. 2022 was a mixed year for digital assets across the spectrum. Firstly, the cryptocurrency market suffered a severe downturn due to challenging macro headwinds, namely soaring inflation and rising interest rates. This was exacerbated by the collapse of the Terra USD stablecoin and a succession of bankruptcies, including crypto lenders and crypto-focused hedge funds. The shock failure of FTX, a one-time leading crypto exchange, only deepened the sense of crisis facing crypto. However, the strong appetite for digital assets remained, particularly focused on security tokens, prompting leading traditional banks to develop solutions which can support these new financial instruments. Metaco conducted a series of podcasts and webinars in 2022 with a diverse range of guests from leading banks, tech firms, and consultancies. So what were the main discussion points? And this is from February 28th, 2023. Crypto faces some tough but not insurmountable challenges ahead. The spectacular failure of FTX in November 2022 and the subsequent charging of its founder with fraud has created a crisis of confidence in cryptocurrency circles. The demise of FTX coincided with the downfall of several other high-profile crypto exchanges, lenders, and hedge funds, concluding what has been a defining moment for the crypto-native world, with the cryptocurrency's market capitalization slipping from a $3 trillion peak in 2021 to $798 billion at the end of 2022. Now, we obviously already know all that. That's old news, but I promise you there is some very exciting statistics in here that I want to get to soon. While some financial institutions have largely avoided cryptocurrencies for a variety of reasons, most are still open to the idea of investing and interacting with the asset class. But the longer-term, bigger opportunity lies in regulated digital securities. Aside from being a new source of investment returns, institutions see tokens in particular as being an effective risk diversifier. Accordingly, the pulse of the event participants, as well as research reports, suggest that the token market will enjoy healthy growth over the next few years, with HSBC and Northern Trust estimating that between 5 to 10% of all assets could be tokenized by 2030. That represents a $20 trillion market opportunity in the near term. All right, this is one of the statistics that I thought was astounding because I have not seen it before. Maybe you have, I have not. First of all, HSBC and Northern Trust estimating that between 5% to 10% of all assets could be tokenized by 2030. That seems a little on the low side to me. To me, that seems conservative. I'm a little bit surprised by that. However, the fact that they put a $20 trillion number next to it is not surprising and is very nice to see. That is just reinforcing some of the big numbers that we see. Now, I'm not saying that all of that is going to Ripple or to XRP. I am not saying that. But I am just saying that in general, for the crypto space, for the industry, this is a very important statistic. There's a couple. The 5 to 10% could be tokenized by 2030, and that's a $20 trillion market opportunity. Those are important numbers. Those are big. That's impressive. All right, we go on. FTX is a disaster for the crypto industry. By the way, there's bigger numbers coming. For the crypto fintechs, for regulators, and for end clients, it is harming the overall public opinions about the industry, but that does not mean that crypto is dead. According to Jan Rossum, partner technology consulting at EMEA Consulting, lead for digital assets and digital currencies at EY. Although the market capitalization of cryptocurrencies has taken a significant dent, Jose Antonio Colomer, head of blockchain and digital offering at BBVA, suggested the asset class should not be written off entirely. Oh, well, heavens no. Here's a quote. Some people would say that crypto is still a very small market. I'm not sure about that because not long ago, the market size was $3 trillion, which if compared to the S&P 500 is very small. But if it is compared with the gold market, then crypto is about a fourth of the size. He continued that even after the crypto winter, the asset class still had a market capitalization that was greater than that of JP Morgan and Visa. I think in terms of the state of the ecosystem, we are in a place similar to where the internet was in the 1990s. There, you need to look at adoption. Today, we have over 200 million users in crypto, which is about what we had using the internet in 1999 or so. Today, the internet has 4.6 billion users. What does that mean for crypto in terms of what we can have in a few years? And also, what does it mean for where the market cap of crypto could be in 10 or 15 years? If you believe in this narrative, the opportunity is huge. Yeah, and I have to just echo that. This is really why I wanted to cover this article today, is to show you the opportunity in crypto is huge. Again, not being specific about Ripple or XRP, but just the whole ecosystem. The fact that this is a repeat of the internet from the 1990s, that cycle is repeating again. This is the next cycle of technology, if you will. And I think it is extremely exciting and is going to create a lot of wealth opportunities, just as the internet boom did. It goes on to say, nonetheless, it is clear that there will need to be some sort of regulation or oversight of cryptocurrencies if the market's fortunes are to recover. Okay, obviously we need regulation, but the important thing here is that we need regulation in order for some of this big institutional money to come in, and that's what we're waiting for. And as soon as we get that clarity, it's Katie bar the door, because all that money is going to come flooding in once they have regulatory clarity, in my opinion. Here's a quote. It really appears that we as humans cannot self-regulate. It has unfortunately been shown time and again. After Terra, USD, Three Arrows Capital, now FTX, it is clear that regulation is inevitable. Well, wasn't that convenient to prove that we couldn't self-regulate? But yet, they let Wall Street self-regulate to a large degree. Interesting. Pointed out Kelly Chia, Deputy Head of Research Asia at Bank Julius Baer. Regulation of digital assets, including cryptocurrencies, is already in motion across a number of leading global markets. Quote, we have seen the markets in crypto assets regulation, MiCA, in the EU, while the Hong Kong Monetary Authority, HKMA, and Securities and Futures Commission, SFC, have published detailed circulars regarding the framework that financial institutions must implement in terms of their operating model, said Adrian Barquesa, director at Simpulse Hong Kong. In fact, Hong Kong's authorities have since announced that crypto exchanges will be subject to the same anti-money laundering and terrorist financing rules as traditional financial institutions from June 2023. CBDCs, NFTs, and tokens gather momentum. Outside of cryptocurrencies, CBDCs, namely digital fiat money issued by central banks, are generating interest in institutional and retail circles as they could potentially expedite cross-border payments and settlements. Here's a quote, I strongly believe that we will have a CBDC one day, sooner rather than later. The European Central Bank, ECB, has made multiple announcements related to the digital euro prototype, with the goal potentially to deliver a true digital euro by 2025. It is pretty short term when you think about it, especially when you consider the impact it could have on the financial markets, but also on things like cross-border payments and retail payments. Again, the needs are there, either for a wholesale CBDC, meaning a CBDC which will apply to large cash transactions, especially in the banking sector, but also for a retail CBDC which can support smaller payments, explained Jean-Marc Stenger, CEO at Societe Generale. Okay, to me, what they just talked about has to do with Ripple and XRP and XLM, Stellar's XLM for the retail side. So for me, when they talk about payments and then the cash transactions in the banking sector and smaller payments, that would be Stellar, XLM, and then the larger and institutional payments in banking and CBDC would tend to be more on the XRP ledger. It goes on. Elsewhere, non-fungible tokens, NFTs, are also gathering momentum, with crypto enthusiasts spending more than $41 billion on them in 2021 alone. NFTs are tokens which exist on a blockchain and are digital representations of real-world assets. Already used extensively in the world of art and collectibles, NFTs are now permeating into luxury goods. Quote, NFTs for the luxury industry is a way to enable ownership and authentication or provenance and transparency. We are able to use the digital certificates to prove the authenticity of the piece, but we are also able to prove the authenticity of the digital token, which is equally important. When we speak about ownership in terms of tokens, we are talking about a customer owning the digital certificate. But who has created this digital certificate is equally important. I say that because I'm convinced that we are going to see a surge of counterfeiting in the digital realm. There will be counterfeiters creating fake NFTs, said Pedro Lopez Belmonte, blockchain lead at Richemont, the Swiss-based luxury company and owner of Cartier, Montblanc, and Net-a-Porter. In order to prevent counterfeiting in this burgeoning market, he highlighted organizations need to educate customers about how NFTs work. However, it is asset tokenization which is eliciting the most excitement in the banking world. Through tokenization, assets, including regulated traditional securities, equities, and bonds, are liquid financial instruments, i.e. real estate, private equity funds, commodities, fine wines, etc., can be digitized and fractionalized on a distributed ledger technology, making them cheaper for retail investors to acquire. Not only will this democratize investment, but it could help shore up liquidity in what are very liquid markets. According to Catherine Guy-Chenard, here we go, subject matter expert at Metaco, the market capitalization of tokenized assets is expected, get this, to skyrocket to more than $20 trillion in the next few years and could potentially even exceed $350 trillion plus in the longer term. Ding, ding, ding. Okay, this is why I wanted to cover this article today. Here is one of the experts at Metaco, which Ripple just acquired, and Catherine is a subject matter expert. She's talking about the market capitalization of tokenized assets is expected to skyrocket more than $20 trillion in the next few years and potentially even exceed $350 trillion plus in the longer term. And I tweeted, I've never seen a $350 trillion number put in print anywhere. I have never seen that before in terms of the size of a potential market. And that is really exciting. That's such a huge number. It's really quite mind-boggling. But again, we're looking at the potential, the future, how the whole financial system is shifting, how tokenization is going to happen to just about everything. And that's exciting because of what we're invested in and how that can play a role in this future. I'm not saying it's going to get all of that money. Please don't misunderstand. I'm not saying it's going to get all of it. I'm saying this market is so big, even a piece of it is going to be tremendous for any company who's involved in these assets. Quote, eventually, the entire capital market could be moving on-chain for all kinds of assets, she stressed. Banks look to respond to the digital asset transformation. Banks are looking for ways by which to capitalize on the surging interest in and demand for digital assets. If anything, the failure at FTX, along with a number of other crypto exchanges, lenders, and funds, has reinforced how important it is for investors to engage the services of institutional and regulated providers when participating in these markets. Jan Rossum, partner technology consulting and EMEA consulting lead for digital assets and digital currencies at EY, underlined, quote, clients will look for a much more trusted party in this business going forward. There is a big role to play for the banks. Nonetheless, he concluded that cryptocurrencies is not necessarily the main priority area for many banks. and they do not want to necessarily support activities like cryptocurrency trading, as the asset class is unregulated and volatile. Additionally, Basel capital requirements for banks holding crypto are likely to be very high, potentially carrying a 1,250% risk weighting, which will be another major deterrent. However, some banks, especially those in emerging markets, which are home to vast unbanked populations, are increasingly recognizing the benefits of leveraging crypto assets, such as stablecoins, as a means to facilitate greater financial inclusion. Quote, an estimated 65% of the population in APAC is unbanked, according to Richard Swainston, Business Development Director at Metaco. In 2019, Union Bank of the Philippines issued its own stablecoin, PHX, which is pegged to the Philippine peso and can provide automatic execution of payments. It is being implemented at Union Bank's I2I, island to island, institution to institution, and individual to individual, blockchain-based platform, which enables connectivity between rural banks in the country. Quote, the idea of PHX stems from two things. First of all, it was our desire to respond to the call of pushing for financial inclusion. The fact that not everyone has access to financial products or the right financial products for their needs has always been one of the pressing issues here in the Philippines, and probably in most developing markets. We knew that in a country like the Philippines, with more than 7,100 islands, it is a bit difficult and not to mention costly for banks like us to reach everyone in each of these islands. I think probably everyone knows by now that digital is key to this, explained Catherine Bautista Casas, head of the Blockchain Center of Excellence Digital Asset Markets in Union Bank of the Philippines. Well, that is a great point. What a great example. If you have 7,100 islands, you definitely don't want to have to build the infrastructure and banks and buildings and employees to try to serve some of these smaller islands, but you can do it all digitally and through your phone and all the ways that we're used to using crypto. That's brilliant. It goes on to say, however, the real opportunity for traditional financial institutions lies with tokenization, Guechenard said. Tier 1 banks are currently leading the way in terms of building up digital asset custody solutions, adding they see tokenization as a huge market opportunity. Custodians are certainly scoping out ways to support tokenization. Quote, we need to build a common infrastructure. If we are embarking on a path where we are tokenizing real-world assets, what is the infrastructure needed for that? Highlighted Nitin Gore, Managing Director at State Street Digital. With investors still reeling from the events at FTX and other high-profile failures, many will be looking to incumbent custodians with strong balance sheets and excellent risk and compliance controls to safeguard their private keys. Maximilian Ruff, business solutions consultant, digital assets and Web3 at Metaco, noted the first wave of crypto-native providers are now making way for a second wave of established, regulated institutional providers, including banks. He noted, quote, we are seeing this paradigm shift from the first wave to the second wave to the wave of established top-tier regulated financial institutions who are building serious institutional-grade market infrastructure. End quote. That is really what Ripple is doing. They are building serious institutional-grade market infrastructure with this acquisition of Metaco, in my opinion. Security and agility. Despite the empowerment of Web3, a Web3 environment could offer investors, experts believe, custodians will have an invaluable role to play in safekeeping digital assets. Quote, being your own bank is hard. The reason being your own bank is hard is because if you have ever tried to carry around all of your net worth, it is a little bit of a personal risk or a security threat. Banks and custodians play a useful role in society. They store the stuff that really matters to you in this one space and will make sure it is not stolen. By the way, custody works in Web3. But the way custody works in Web3 is so powerful because it has created this global CRM of assets, said Simon Taylor, head of strategy and content at Sardine and co-founder at IFS. Banks also have the added advantage that they can support clients who are trading traditional securities in parallel with digital assets. Quote, we do not look at digital assets as being different from traditional financial assets, acknowledged Michael Clayton, Chief Technology Officer at Levelfield, a U.S. challenger bank. Although banks can potentially offer excellent security, when custodying digital assets. This cannot come at the expense of agility, a traditional strength of the fintechs and Wave 1 service providers. Quote, our view is that the source of future competitive advantage for all institutions that enter the space is to operate with no trade-offs. You need to have the ability to have high agility, flexibility, and, not or, to be highly secure and compliant, said Seamus Donahue, Chief Growth Officer at Metaco. End of article. Well, wow, there was so much in there, but wasn't that something to see that statistic? Let's just review that again, because that was absolutely mind-boggling. According to Catherine Guay-Chenard, subject matter at Metaco, the market capitalization of tokenized assets is expected to skyrocket to more than $20 trillion in the next few years and could potentially even exceed $350 trillion plus in the longer term. Wow. Okay, well, I will leave you with that thought. This is why we're doing the drill downs, because we get the good little morsels out of some of these articles that have a little sentence in there, here or there, that is possibly new to us, possibly mind expanding, and we can just learn a little bit more. Again, just tremendous potential and things happening in the marketplace that are moving in the right direction and tokenizing assets, just incredible things beyond cross-border payments. So many exciting things. We talked about NFTs as well. So lots of very exciting things on the horizon. If you like these drill downs, please like, share, and subscribe to my channel. And if you would like to know about other topics other than crypto, I have my podcast 3 times a week, Be Wealthy and Smart, Monday, Wednesday, and Friday. And that is also on my YouTube channel or over on iTunes or wherever you enjoy listening to podcasts. And I also have little wealth tips that I post daily over on my Instagram at instagram.com/Linda P. Jones. And of course, my website is lindapjones.com. That's all for today. Until next time, live the good life and be wealthy and smart.